Our first slide is, it should be of no surprise to you in terms of setting the scene. We're in a different environment. You could argue a little bit more volatile, characterized by rising populism. And the question is, what is the root cause for that populism? Now, apologies for the complexity of the chart, but we're comparing income by decile from when the baby boomers were born to the current situation. And as you can see, the top decile is significantly better off. So we don't think it's any surprise that politicians are under pressure to find solutions. And unfortunately, for a whole lot of reasons, politicians seem to have outsourced economic policy to central banks. And central banks seem to have one trick, and that's called QE. And quantitative easing actually seems to make the problem worse, not better, because it ultimately creates inflation in asset prices. It does very little to alleviate income inequality. It even actually makes it more, if you like, uncertain for labour, for traditional jobs, because it basically lowers the cost of capital. So it lowers interest rates, creates speculation, and it allows venture capital to disrupt entire industries. So in many ways, QE is accentuating populism. I think an example is just if you look at the bottom decile of income earners in the US since the global financial crisis, their real incomes have fallen 3%. So it's no surprise that we're electing politicians who are going to pander to that, to anyone who's really willing to listen. Whether or not they have an answer is the question. In the words of a different Donald to the one that grabs all the headlines today, that would be Donald Rumsfeld. In these uncertain times, it's about dealing with the known unknowns and then trying to also take into account the unknown unknowns. A bit of a tongue twister. Unfortunately, though, humans, we're all pretty bad at, predicting the unpredictable. In financial markets, the reality is that we have what you might describe as fat tails. So unpredictable events tend to happen with a degree of regularity, whether it's credit crises, sovereign defaults, currency devaluations, you name it. So the Jenga tower analogy, I think, is a good one. As you're building the Jenga tower, you can observe it becoming sort of fragile, but it's very hard to know where the pieces are going to land. So I think as investors, it's actually understanding, how we can sort of control those risks before they happen. We have to do this in a prospective way. Why are tail risks, I think, happening with increasing frequency? I think it's a simple outcome of the fact that we've moved into a monetary environment that's less forgiving. So if you look at the aggregate balance sheet of the major central banks, it's now declining. So central banks are starting to unwind QE. Now, you might ask, well, why? Why would they do that? We still haven't really got inflation outside of the US. We know that China and Europe are struggling to sustain their recoveries. And arguably what's happened is the Fed has really been pushed into very close to a policy mistake. Now, why has that happened? Well, once again, populism. When Trump was elected, what was the first thing, one of the first policies, the only policy that really has managed to get through Congress has been tax cuts. And the budget deficit the US is running now has only been exceeded in basically times of war. I mean, this is a very unusual event to not only have very accommodating interest rates, but to also have very accommodating fiscal policy. So the Fed's has had to try and sort of offset some of that fiscal stimulus, and arguably has tightened way too much relative to what's going on outside of the US. So it's almost like we've had fiscal exceptionalism in the US, which has driven this policy error. So whilst the Fed may be on pause, arguably some of the damage has already been done. These multiplying tail risks, my only comment would be that some of these do not have simple solutions. I mean, in the case of trade wars, whilst we may see positive headlines, it would seem like Trump wants to do a deal. The bipartisan situation in the States is that Republicans and Democrats, and even outside the US, if you go to the European Union, genuinely want to drive a change in Chinese industrial policy. So it's less about the trade deficit that the US has, and it's more about their view of China emerging as a true global competitor in a geopolitical sense. And it is about restricting Chinese access ultimately to technology. That's what it comes down to. And that is not, we don't think that's going to go away. That seems to win votes in the US and in Europe, regardless of what side of politics you're on. So I think you need to basically prepare mentally for a world where it will be different. The big wave of globalization that we've experienced and we've all benefited from is starting to slowly reverse. We've seen central bank policy arguably lead to other distortions, structural growth, which we measure as basically a measure of the valuation of the companies, the fastest grow, the most rapidly growing companies versus the slower growing companies. The valuation of the high growers is about 3 standard deviations above its long-term trend. So in a world where real rates have declined and you've had geopolitical uncertainty, investors have crowded into growth and quality. You've had a bubble in both. And then in credit, what we observe is that the worst companies have basically tapped, in the US, have tapped the credit market. And we'll come back to that a little later. China rebalancing, we're going to be talking about that one, I think, for decades, because it's a big problem for China. They've had such an investment bubble that it will take a long time for the economy to reweight towards consumption. It will happen, but it will happen slowly, and it will be very stop-start. Having said all that, what's really changed? As investors, we've always had to deal with uncertainty. And our job, I think, is ultimately to try and build portfolios with a strong foundation. So that starts with basically looking for companies where we find multiple ways of winning in the investment case, primarily because not only are they cheap, but they're resilient businesses. They're businesses that are not being disrupted, or they are leading the disruption. Secondly, inform the portfolio construction with a rigorous quant and macro process. So identify areas in the market that are potentially dangerous, that we don't want to have concentration or correlation to, whether it's macro risk around high yield credit, protecting our equities, making sure we don't have equities with weak balance sheets. If it's around China, because we're worried about Chinese growth, making sure our Chinese companies are structural growers. If it's Europe and it's concerns around the sustainability of the Eurozone, making sure we have appropriate hedges in the portfolio to the extent that that is a bad outcome. And it ultimately feeds our currency positioning. When we go up to our final portfolio construction, the question is, can we find cheap tail risk hedges? Now, the problem with most tail risks is they're binary. And by the time they occur and they're in the headlines, there's no way you can hedge it because the hedge is expensive. So when markets are ignoring the tail risk, find cheap insurance. Look at, and in Antipodes, that typically means we find a mispriced asset that is going to trade very badly if the tail risk occurs. So if there's a bad outcome in the European Union, can we find a credit instrument that will trade in our favour? So it's basically hedging our equity risk using a multi-asset toolkit. But you have to do it before it hits the headline. So a quick overview of our portfolio and how we're positioned. What we're trying to capture here is our portfolio positioning relative to valuation. If starting at your left and coming over, North America domestic. Now, we break all regional markets into sectors that are more global and more domestic. So domestic, relatively self-explanatory, banking, telecommunications, infrastructure, property. Global would be technology, healthcare, industrials, commodities. You can see from our portfolio, we're significantly underweight US domestic. Doesn't mean we're underweight US global, we're not. We like many of the multinationals in the US. We think they're undervalued. But we think the domestics, as I'll come to later, are not cheap. The red line there identifies where that sector is priced versus its long-term relationship to the market. So red is overvalued, approximately 2 standard deviations expensive, and green is undervalued. It's not surprising as a value investor that we have more of we're more exposed to the greens than the reds. And so moving across, we're moderately underweight the global defensives. And then where we are overweight tends to be more the cyclicals, global cyclicals. They have derated significantly given concerns around China. We're exposed to some of the European domestics and also some of the Asia domestics and a small position in gold. The question with the US domestics, why is it such a big underweight for Antipodes partners? It's not because we're fundamentally biased against the US. We think some of the best companies in the world exist in that market and we love to buy them when they get cheap. The problem is that the European domestics have had tailwinds. They had the benefit of the Trump tax cuts. They have had low interest rates. You've got an economy that's basically operating pretty much close to full employment. Arguably, it's as good as it gets. And, you are starting to see fairly broad cost pressures. And even if the Fed is on hold, when you're operating close to full employment, you are going to see those cost pressures continue to build in the economy. Labor, transport, and you are seeing bottlenecks. You've also had all the benefits of the long-term globalization story, not unique to the US, obviously by definition, global, but the tax cuts, the weaker dollar, and this final point, technology innovation. US companies are probably the most progressive, they're most aggressive when it comes to adopting innovation in new tech. Now, you'd think, well, that's a positive. Surely that's a positive. I mean, the problem is many of the domestic parts of the market are the victims of that disruption. What companies are leading the disruption? It's Amazon, it's Microsoft, it's these global multinationals. In retail, there's significant pressures, competitive pressures building. Now, if you found a strong incumbent retailer that had an answer to Amazon, Antipodes would have no problem buying it. Absolutely. We think Walmart is in a very strong position to compete with Amazon. But Walmart's the exception. When you go across, the rest of that sort of general merchandise retailing industry, what you find is companies like Target, like Kroger, that have basically just bought back stock. What have they done since the global financial crisis? They took the low interest rates that the Fed gave them and they invested in their stock, not their business. So you have now record levels of leverage in these companies at a time that they actually need to invest to fight off Amazon, to fight off Walmart. So they're the sorts of stocks we're trying to avoid in being underweight the domestic US. You can see the chart. It's very simple. It's a PE. It's a relative PE chart of the domestic US versus the same stocks in essentially Europe and Asia. So significant derating. So you could argue a lot of the concerns around disruption outside of the US have already been reflected in the valuation of the stocks. We think the worst is to come in these US domestic stocks. Turning to the part of the US that we like, the multinationals in areas like software, the issue here is that cheap money has sped up. that disruption. You have two competing forces here. You've got what we call the incumbents, the incumbent software companies, versus the disruptors. We've just chosen Uber because our head of quant found this interesting promo board at Sydney Airport. But once upon a time, most people would have thought, your choice was Uber versus the traditional taxi. Now, as a result of this bubble in venture capital, you can see all of these Uber copycats. Now, we don't think any of these companies will survive, really. I think it will come down to Uber plus maybe one other, potentially a duopoly. But it's going to be a bitter fight to the death. And whilst money is easy, and whilst entrepreneurs can get access to capital, they're going to have a go, because the one thing the internet has taught every entrepreneur is that the payoff for success is immense. Now, we didn't understand that when Google launched. We didn't understand what the network effect was. These couple of guys, I think in Stanford, who founded Google, they understood it, maybe. They quickly understood it. The founder of Facebook understood it. But now everyone understands it. It's not a competitive advantage. And so there will be more and more bitter fights to the death in the between the disruptors and the incumbents. So we think you are better off, in a bubble of growth that we're currently living in. You've probably got more chance of making money by finding an incumbent that is actually getting stronger. So when it comes to enterprise software, we observe a real dichotomy. You've got companies like SAP, Cisco, Microsoft. We own all three of those companies. But we've looked at the valuation across the top 10 enterprise software companies in the world, and they're trading on 21 times free cash flow. Now, our stocks on average are below that. They're even cheaper than we're taking the best, we would argue, out of the group. And you know what these businesses are. If there's anyone here who, as a CFO, has used SAP, you absolutely know that they have a lock on you. The idea that you're going to one day transition your enterprise off SAP is a pipe dream. They have significant pricing power, and each of them, whether it's Cisco and Microsoft, is basically using that lock to add additional features to their offering. Office 365 now has collaboration tools that actually work. And so who are they potentially taking market share from? Well, you've got all your disruptors who are coming in. They're using venture capital. Capital markets are allowing them to issue stock to their employees. They don't have to pay their employees. They just pay them stock options. And when stock's going up, that works. When stock's going down, it doesn't work quite as good when it comes to employee retention. We don't think they offer multiple ways of winning, primarily because they don't have a lock. But it's actually worse than that. They're not priced. They're priced for perfection. And I just want to share some statistics about how we think about this and putting these companies in a relative context. The R&D of the incumbent platforms is almost double the sales of the disruptors. The R&D that these platform companies spend. This is it's very, very, very tough. Now, you could say some of that R&D is wasted. Yeah, absolutely. But it's still very easy for those platforms to add features that just steal the whole business from Dropbox. I mean, does Dropbox really have a purpose if you can use OneDrive in the cloud with Microsoft? Can it survive? Can it actually charge for that when effectively it's been given away by Microsoft? Now, when it comes to sales, what we're illustrating here is how much revenue last year did the top 10 software companies take versus our cross-sections of disruptors. So the big companies are growing fast. They've taken 6 times as much revenue as the disruptors. So we just would caution people to assume that high growth today can continue in the future. Be careful around extrapolation. Some of these disruptors, whilst they are growing fast, they may hit the wall when one of the platforms decides to seriously compete in the segment that they are in. So on our portfolio, very quickly, as you know, we invest via clusters. We see that as a way of keeping the productivity of the research process very high, being able to be much more deeper in each of our investment ideas. And we also see it as a way of managing correlation in the portfolio. Our global cyclicals, it was a tough year for cyclicals last year, but we think these are generally higher quality cyclicals that each has an end market that we think is interesting and ultimately mispriced for what they are. The domestic cyclicals were generally in Europe and Asia, not the US. We like some of the defensive parts of the market, even though it's generally expensive. We've found, and the software cluster that we have, which is long and short, certainly has defensive characteristics on the long side. The telco incumbents, very out of favour sector, but we think it's one where there is, in a world where you do have combinations of cable assets and mobility assets under the same roof, which obviously discounts our local market. We can find companies that will basically flourish in a 5G world. And then, moving down to the shorts, generally we want to be short the overhyped growth stocks, which includes some of the software shorts we have. We do believe that there's cyclicals also, given the volatility of the environment. There are ways we can hedge our long cyclicality with shorts, and we've generally been reducing our bond proxy shorts, which takes me to the final slide. When we set up Antipodes 3.5 years ago, we ultimately had an ambition of basically building a process that could generate alpha at scale and ultimately offer very good characteristics between upmarket participation and protection from down market. And you can see that in our capture ratios. That remains our long-term commitment to investors. Thank you.